Our last episode took us into the world of CPI Aerostructures, Inc., that's CVU. Today, we're shifting gears, diving into a company that, well, really embodies the new space economy, Sidus Space, Inc., ticker symbol SIDU. They're based down in Merritt Island, Florida, founded back in 2012. Sidus Space calls itself a space-as-a-service provider, operating in the aerospace and defense sector. They're involved in pretty much everything, from designing and manufacturing commercial satellites to orchestrating launches, managing missions, providing in-orbit support, and really crucially, collecting and delivering data and predictive analytics. So the central question we're wrestling with today is this. Is Sidus Space a thrilling speculative growth opportunity fueled by cutting-edge space tech and smart strategic partnerships in a market that's clearly expanding? Or do its persistent operational losses, its reliance on dilutive financing, and frankly, a plummeting stock performance paint a pretty stark picture of fundamental financial weakness that investors just can't ignore? I'll be arguing for SIDU's potential, focusing on its innovative approach and its long-term strategic vision.
And I'll be taking a hard look at the company's significant financial struggles, its precarious cash position, and the really substantial erosion of shareholder value we've seen. My perspective suggests, well, a much more cautious view of its current financial health and, frankly, its long-term viability.
Right. So my core belief here is that Sidus Space is actually exceptionally well positioned for significant long-term growth. Their whole space as a service model, it isn't just a buzzword. It's a comprehensive approach to space operations. They're offering multi-mission satellites, advanced sensors for a truly diverse range of applications. And, we've seen a flurry of strategic partnerships and agreements that I think strongly underscore this potential. Consider the advanced and extended $120 million agreement with Lawnstar that's focused on a lunar data storage spacecraft fleet with deployments scheduled for next year. I mean, that's a potential game changer. Beyond that, they're working with Virago Technologies to enhance radiation-hardened compute capabilities. They forged a joint venture, Sidus Arabia, over in Bahrain for 3D printing satellite manufacturing. And they also have agreements with Warp Space for optical space communication and Reflex Aerospace for global satellite solutions. This isn't just, a handful of deals. It's a broad, pretty ambitious collaborative strategy. It looks like they're aiming to corner various segments of the market. Now, let's talk innovation for a second. Their product and technology development is, it's truly remarkable, and it seems to be accelerating. They've successfully launched LizzieSat 1, 2, and 3, which are rapidly expanding their AI-driven on-orbit capabilities, the deployment of advanced space pilot software, the commissioning of LizzieSat 3's attitude, determination, and control system by August 2025. These things demonstrate their operational maturity. They're also protecting their IP, securing a U.S. patent application for a modular satellite command and data handling system. These aren't just R&D projects. They seem to be translating into real business. There are additional contract awards for NASA Astra, a $2 million contract for a U.S. Navy propulsion program, both in 2024. Now, when we look at the historical growth metrics, EPS grew, 45.78% over the past 3 years, 21.26% over 5, while sales were up 49.13% and 10.80% respectively over those same periods. And you pair that with the projected EPS growth of 68.83% for the next 5 years, it paints a pretty vivid picture. This is a company in a capital-intensive industry making substantial foundational investments for a significant future. And the analyst sentiment seems to agree. A RECM of 1.00, a target price of $10. That suggests professional optimism for its long-term trajectory, despite, yes, the current share price of 1.06. This scenario isn't just about Sidus. It kind of spotlights a common paradox in the commercial space sector, that tension between immediate financial stability and the massive, often necessary upfront investments you need to carve out future market dominance. It's a high-stakes gamble in the future, sure, but one where the payoff, if realized, could be monumental.
Okay, I understand the optimism those figures, especially the projections, might inspire. Yet the underlying financials tell a very, very different and, frankly, far more concerning story. While the partnerships and the tech advancements you've cited are, yes, impressive on paper, a critical look at Sidus Space's financial performance reveals deep and persistent unprofitability, and that raises significant questions about its long-term viability. The numbers are simply stark. Net income is a staggering negative $21.62 million against sales of only $4.19 million over the trailing 12 months. This isn't just slight unprofitability, it's an enormous cash burn. Their gross margin, what's left after direct costs, is negative 80.29%. Operating margin, negative 363.77%. And profit margin is an astonishing negative 515.38%. These are not the metrics of a company on a sustainable path. They report a negative EPS of minus $1.98, and even their projected EPS for next year remains negative at minus $0.80. Beyond the income statement, the returns on capital are equally dire. Return on assets, ROA, is minus 83.94%. Return on equity, ROE, minus 157.68%. And return on invested capital, ROIC, minus 145.18%. These deeply negative figures mean that for every dollar of assets or equity, the company is losing significant value. It's essentially eroding its capital base, not expanding it. And the market has certainly reacted severely to this. The current share price, $1.60 as of September 17th, is down an alarming 86.14% from its 52-week high of $7.65. And it's barely above its 52-week low of 93 cents. The performance metrics are truly shocking. Year-to-date, down 78.37%, down 60% over the past year, and an almost complete wipeout, down 99.60% over 3 years. Quick ratio of 0.73 and a current ratio of 0.76 both signal potential short-term liquidity challenges, meaning the company might struggle to meet its immediate financial obligations. Their frequent reliance on public offerings and private placements, we saw them in September 2025, July 2025, December 2024, November 2024. It clearly demonstrates a continuous need for external capital, and this inevitably leads to significant dilution of existing shareholders. As new shares are issued, ownership gets spread thinner, reducing the value of each share. We've seen substantial stock price drops right after these announcements, like minus 28.7% in September, minus 42% in July, minus 47% back in November 2024. Finally, valuation metrics like a price to sales, PS, of 6.44, meaning investors are paying over 6 times revenue, which is high for an unprofitable company, and an EV to sales of 7.67, also looking quite rich. They seem entirely unjustified given such deep losses. And with insider ownership at a mere 0.87%, and institutional ownership at 2.93%, it suggests very limited skin in the game from those closest to the company or from large sophisticated investors. Yes, Jeffrey Schumann made some insider purchases, but the overall ownership picture is strikingly low. This case really serves as a stark reminder. A compelling technological vision, no matter how grand, often collides with financial realities. It highlights the critical need for a sustainable business model that can eventually generate its own capital, rather than perpetually relying on the market to fund an ever-expanding burn, leading to, relentless shareholder value erosion.
I understand your concerns regarding the current financial metrics, and yes, those are significant numbers for any business. However, I would frame this situation through a different lens. In a truly capital-intensive, high-growth sector like space, initial losses are not only expected, they're often necessary for disruptive innovation. Sidus Space isn't just burning cash. It's actively building out critical long-term infrastructure. We're talking about the LizzieSat constellation, developing sophisticated AI capabilities for space, securing those major long-term contracts like the $120 million Lone Star deal. They're investing heavily in groundbreaking tech like Lunar Lizzie, the Fortis VPX modules, their patented systems. These are foundational investments, building future revenue streams in a market that looks poised for exponential growth. The historical growth in EPS and sales, and particularly that projected 68.83% EPS growth over the next 5 years, is strongly suggests that these current losses are part of a strategic build-out. They're laying the groundwork for substantial future revenue and, crucially, profitability down the line. It's the cost of pioneering in a nascent, high-stakes industry. And these are the companies that, if successful, can deliver those outsized returns.
That's a compelling argument about pioneering, but I'm sorry, I just don't buy that the scale of these losses can be entirely waved away as simply growth stage investment. And negative $21.62 million net income on only $4.19 million in sales, with gross margins at negative 80% and operating margins at negative 363%, that indicates far more than just expected initial investment. To me, these are indicative of fundamental operational inefficiencies and a business model that, as yet, appears incapable of generating positive returns from its core activities. You talk about these as necessary growth stage investments, but at what point do these investments become simply unsustainable burn, especially with gross margins at negative 80%? I mean, where's the line in your analysis?
Okay, that's a fair challenge.
The continuous, aggressive need for dilutive financing, issuing new shares, reducing the value of existing ones, which has consistently wiped out shareholder value right after the announcements, that clearly signals a struggle to achieve self-sufficiency. If the growth strategy perpetually requires selling off parts of the company just to stay afloat, you have to ask questions about the sustainability of that very strategy in the long run.
Okay. I see the challenge you're posing regarding sustainability, but let's also consider the strategic vision and the team they're putting behind it. The company's innovation pipeline is robust. It's forward-looking. It demonstrates, I think, a clear path toward market leadership in advanced space solutions. They're not just making announcements. They're showing tangible progress with the LizzieSat launches, the deployment of space pilot software. Furthermore, appointing experienced board members like Tiffany Norwood and Levanson Coffey III, bringing in a new CFO, Adarsh Parekh, back in January 2025. That strengthens management's ability to execute this vision. These are deliberate initiatives designed to capture a significant share of what is clearly an expanding global space market. These actions, combined with their technological achievements, show a commitment to long-term value creation. Now, you've highlighted the low institutional ownership, but isn't that often characteristic of a company at this very early, highly speculative stage, before it hits an inflection point? What level of institutional backing would you even consider healthy for a company with Sidus's ambitious roadmap, given its current stage of development?
That's a fair question about institutional ownership at an early stage. But the fact is, the tangible impact on shareholders has been devastating, a near 90% decline from the 52-week high, and that truly catastrophic 99.60% drop over 3 years that cannot be overlooked simply because of future promises and a strengthened management team, however capable they might be. Despite the frequent news partnerships, product launches, tech developments, the financial results consistently show an inability to translate that innovation into profitable growth. And this leads to significant, continuous erosion of shareholder value. So while I acknowledge the strategic announcements, the market is clearly voting with its feet. The current stock price, hovering near its 52-week low, reflects, I think, a profound market skepticism that these strategic visions will ever materialize into a financially sound business for its investors. The critical point isn't just the lack of institutional ownership, it's the consistent underperformance that likely makes large investors wary in the first place.
The consensus target price of $10 and a strong RECM of 1.00, that suggests that market experts, those who study these companies intimately and have models to project future earnings, they see significant upside potential. They are likely valuing the long-term vision, the technological advancements Sidus Space is pursuing. They understand that pioneering new frontiers requires substantial upfront investment before profitability stabilizes. The market cap of, $26.98 million and an enterprise value of $32.13 million. While small, yes, it still represents a valuation for a company that is clearly perceived to be in its early high-growth phase. These analysts aren't blind to the current financials, but they're projecting where this company could be.
I understand the analyst's perspective, but frankly, I'm not convinced by that line of reasoning when it's so detached from the current market reality. The stock trades at $1.06 per share. That's a dramatic divergence from a $10 target. This, combined with the consistent underperformance and the deep unprofitability, indicates that the broader market is decidedly not convinced regardless of a single analyst's optimistic projection. The low institutional ownership of just 2.93% further reinforces this. It suggests a distinct lack of confidence from major investment funds who typically look for stability and clearer paths to profitability, even within growth stories. The high volatility, 14.26% daily, 7.54% weekly, and that negative beta of minus 1.36, indicating its stock often moves opposite the broader market and with greater volatility. Well, it just underscores the highly speculative nature of this stock. It's detached from broader market trends. It's really a gamble, not an investment supported by current financial performance. So the question for investors truly becomes, is this a calculated risk for a potentially huge future reward, or is it just a value trap disguised as innovation?
Okay, Sidus Space, Inc. It clearly presents a complex financial picture, balancing an ambitious technological roadmap against, yes, significant operational losses. From my perspective, it represents a compelling, albeit early-stage investment in the innovative space sector. Despite the current financial challenges, the substantial potential from its strategic partnerships, its groundbreaking technological advancements, and that ambitious roadmap for space as a service, well, that cannot be overstated. It's a company building the future, and that demands patience and a long-term view.
I agree it's complex, but my view emphasizes that the severe, persistent operational losses, the precarious liquidity, and the significant shareholder value destruction we've discussed, these present fundamental financial weaknesses. These issues must be critically evaluated against any future growth projections. While the vision is grand and the technology is exciting, the current financial reality raises serious questions about its viability and the sustainability of its business model without continuous, highly dilutive capital infusions.